Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. This week, I'm speaking with Jawad Mian, chief strategist at Stray Reflections, an independent global macro research and trading advisory. Now, one of the reasons I wanted to speak to Jawad this week is because he looks at markets with quite a historical context, and regular listeners will know that we're mildly obsessed with the stock markets of the 1960s and the 1970s, what happened there and how that reflects onto today. So, Jawad, thank you very much for joining us. Welcome.
Pleasure to be with you.
So let's start by looking at the 60s and the 70s, what happened in those markets and how you feel they tell us something about today.
So there are a couple of interesting trends that we've seen recently that we can find echoes in the past. In the last decade, we talked about, especially post-pandemic, there was this idea of the YOLO market and the SPAC boom. And when you go to the 60s, what's interesting is back then you had Jerry Tsai, who led this movement within the go-go years, as it was named. Go-go fund assets increased from $200 million in 1963 to $3.4 billion in 1968, an increase of 17 times. And you can compare that to Cathie Woods, who became the star of the YOLO market in some ways. And her firm's assets rose 17 times as well, from $5 billion to $85 billion, another increase of 17 times. The go-go funds made 344% between 1963 and 1968. Woods' flagship fund, ARK Innovation, jumped more than 350% just from the pandemic low to February 2021. The other thing was back then you had the conglomerates boom. And John Brooks described that as an era of show-offs and shenanigans. And that sort of led to, again, what we see today, or more recently, SPACs, which was a once obscure niche investment vehicle. It became the hottest trend on Wall Street. And then the third thing I would say was the idea of how retail completely changed the landscape. Back then, Merrill Lynch opened over 200,000 new brokerage accounts in the first 5 months of 1968. And there were about 31 million Americans who owned the stock, more than 1 in every 4 adults, a 53% increase since 1965 when there were just over 20 million. And if you look at it, again, comparing it to the recent times, you had 59 million people who held accounts with one of the top 7 US brokers in 2019. By 2021, that number reached 96 million, a 63% increase, with 17 million new accounts opened in 2020, and 20 million more in just in the first half of 2021.
Okay, so you have this dynamic where you have a big name kind of leading. You have the hero fund manager, right? You go through this period. And Gerald Tsai, he was with Fidelity, right, initially, and then set up on his own and became a sort of a brand in his own right. Same as Cathie Woods, who, by the way, we have had on this podcast before. Anyone who's interested in what Cathie Woods thinks about markets, please go back and listen to that one. It was also great fun to do. So you have these sort of celebrity fund managers, you have these fast rising markets, you have these products that old timers in the market might look at and say, well, that makes no sense. But maybe you have a new generation of investors who haven't seen bad things happen in the market before. And so they come on at speed. You get this huge retail participation. You get a bubble. And then, of course, eventually the old-timers who've been bearish for far too long are right. But after everyone else has made a big pile of money. That makes sense. But we're still in a bull market. Cathie Woods is her performance might not be so good anymore. So maybe we can compare her to Gerald Tsai back then. But nonetheless, we are still in a bull market. It doesn't reflect exactly, right? Or does it?
It does, I think. So let me explain the price action, right? So back then, from the 1966, the bear market in 1966, we had a first stop, and then the S&P 500 dropped 24%. And that bear market lasted 8 months. It was not followed by a recession. Instead, a new speculative binge, the second in the decade, took hold. And the average daily trading volume for 1967 on the NYSE surpassed 10 million shares, a new high by a long shot. And compare that today, we had the peak in January 2022, and what followed was, again, a 27% bear market over 9 months. No recession followed, and we've had another stock market boom that's continued. In 1968 was the second peak, and it was 16% above the 1966 peak. And this led to the next big decline of over 30% over the next 2-3 years, wiping all of the gains out from the go-go years. And again, right now, this is where we are. The key point is this: after a climactic event like the 2021, peak exhausts speculative energy, the next phase isn't another vigorous bull market, but a more subdued one with sort of less upside. And so here we are today, where we're about 20%, 25% up from the 2021 level. And we're seeing concentration in the Max 7 names, which speaks to the desire to be in trusted, cash rich, earnings generating companies, more so than the speculative boom that we saw previously.
Yeah, although 25% up doesn't feel very subdued. That feels like that's quite a big rise.
Only if you think that this can continue, right? I mean, 25% over the 2021 high, to me, does not seem very significant. And I think it's about where do we go from here?
Okay, well, I guess that is the key question then. Where do we go from here?
Look, I think what's interesting is if you also jump into the 70s next, you'll notice that there's another comparison that you can make between the Max 7 and the Nifty 50 stocks. And back then, the Nifty 50 stocks traded at about 42 times earnings at their peak, more than double the S&P 500's average of 19. And their valuations were said to be okay because these guys were going to continue to grow into their earnings. Like no price was high enough. And while that prediction was correct, the misconception was it didn't matter what you paid for them, because they continued to generate earnings growth around 9% over the next 25 years, but they had to endure a pretty decent decline over the 1970s bear market. And then the Magnificent Seven, like the Nifty 50 at their peak, were trading at more than double the S&P 500's valuation multiple in July of last year. The basket as a whole has peaked in December of last year. And so if history is any guide, we have to keep in mind that the price matters. And so the idea is, what if the S&P 500 is right now reaching heights that won't be surpassed for the next decade? So what I mean by that is, if you do see a 30% decline from here, and we can discuss specific reasons as to why that may happen, but if you see a 30% decline from here, you're looking at a bottoming somewhere around 2027. And it takes about 2.5 years to typically recover from a bear market low to the high water mark again, which means we could be stuck around the 6,000 level back in, again in 2029 or 2030 even.
Yeah. Well, let's go back to the Nifty 50. I mean, the lesson that was learned then that needs to be learned over and over and over again, it seems, is that a good company is not necessarily a good investment, and price does matter. So the feeling then, and you get this feeling now as well in large parts of the market, I think, the feeling then was that it doesn't matter the price you pay, because this is a great company. It's going to keep growing. It's solid. It's absolutely fine. These things were absolutely true about lots of those companies, but still the price can be too high. So that was the lesson that investors learned then, and some investors have already forgotten.
Yeah, it's so interesting because even if you bought the Nifty 50 stocks at their peak, the return from those investments would have still closely matched the S&P 500's 12% annual return over the next 25 years. But it's just that you had to endure a decline in some of those stocks upwards of 85%.
Yeah, so you just paid too much up front and you had to wait a long time for that return to come. But it did come, which is crucial. So if you look now, let's take that over to the Magnificent Seven, or perhaps the AI or the AI adjacent stocks, as we now call them. And again, we look at those stocks, or part of the market looks at those stocks and says it doesn't really matter what you pay because they will grow into those valuations, which might be true. But that growing into the valuation could take a very long time, and there could be a big correction first. Is that the correct way to look at the mirroring from the 1970s?
I think so. And I think we've reached those sorts of extremes. And our fundamental belief is that, whatever period of the last few decades we look at, and we can get into the 80s and the 90s as well, but we believe that stocks are in a topping process more broadly. And the topping process isn't a specific point, or there's just one catalyst. It takes, typically, 7 to 8 months, up towards to 12 months, because different sectors and styles speak at different times. But just for, context sake, let's keep in mind that the Nikkei peaked in July of last year. Microsoft peaked in July. The semiconductor index peaked in July. The high yield sector, peaked in September. Home builders peaked in October. Now, semiconductors and the home builders were the top two performing sectors since the October 2022 low. Following that, you've had, in November, MicroStrategy peak, the transports peaked, small caps peaked. Mag 7, like I said, as a basket peaked in December. Apple and Tesla peaked in December. Meme coins peaked in December. Nvidia peaked in January, and so far Bitcoin has peaked in January as well. So we can see this sort of overarching topping process developing, and they're now a function of what are specific catalysts that could happen, that could lead us into a bear market.
What are they?
So I think there are certain conditions that are necessary but not sufficient, amongst which is bullish sentiment. It is consumer expectations for stocks over the next 12 months. It is stronger dollar, higher interest rates. It is insider selling, mutual fund cash levels at record low levels. All of these things are part of what you want to see as necessary but not sufficient. And I think what's interesting is the DeepSeek news moment that occurred recently, I think creates a crack in the AI narrative to an extent. And Soros had this sort of framework of how he would look at a bubble which follows a predictable pattern. And stage 4 of a 5-stage process was a twilight period where faith wavers. And I think what we're seeing with DeepSeek is this idea for the first time in this cycle that perhaps we may be able to lower the cost per unit of intelligence going forward. Every bubble, every innovation, every technological wave has followed a similar pattern of innovation, replication, eventual democratization driven by competition and cost reductions. And it looks like that's happening again. So we will be finding more efficient approaches to challenge the brute force GPU intensive paradigm.
And this is the case with every period of intense industrialization or some kind of technological change. You very often find, and we've seen this again, I mean, there's been lots written about it, happening with the railways, happening with the internet, happening with, cables, et cetera, that the people who put the vast amount of money into the capital expenditure in the first wave of the new technology aren't necessarily the ones who really benefit from it.
Absolutely. And I think a core belief underpinning the AI bull market was that the massive infrastructure spending will create unassailable moats for the US tech giants. But we're still seeing that the returns on those investments remain unclear. It's definitely going to impact their return on invested capital. And I think starting the next earnings seasons at some point this year, we will see shareholders begin to question those endless capex plans if they dilute future returns, right? Because I think cost-effective scaling now matters much more than chasing performance breakthroughs, which American tech giants are sort of focused on right now.
Might that then challenge the idea of American exceptionalism? And we talk about this quite a lot on this podcast because there is a general idea, particularly among the new generation of investors, that the American market has always been exceptional and that it's completely natural for the American market to be valued significantly more highly than any other global market. That's just normal. Whereas, of course, us as oldies know that that's only a function of the last 15 or so years. And before that, it wasn't the case. Does this shift in the AI narrative, perhaps, is that the first beginning of a challenge to the idea of American exceptionalism?
So let's remind listeners, right? So if you think about it, coming out of GFC, America was not the place you wanted to invest. You had the 2010 flash crash. In 2011, you had the credit rating downgrade. The dollar was at a 50-year low. In 2012, Facebook went public and it was a disaster. The IPO flopped. It was the world's largest technology IPO. Obama was increasing regulation. There was mistrust of the Fed. Top investors and economists were writing a letter saying, stop QE, you're going to create hyperinflation, you're going to debase the dollar. At that time, Merryn, the thinking was emerging markets deserve a higher PE because of their superior growth prospects. Commodities deserve an allocation in your portfolio. So as Sherlock Holmes would say, there's nothing more deceptive than the obvious fact. But that was the time you wanted to really be invested in the US. And I think what was exceptional about America was last decade. 3 specific things. First, America had political and policy leadership. The first of which was coming out of GFC, the Fed began QE, cleaned up the banks before any other country did. It followed with Trump's tax cuts and deregulation. So you had political and policy leadership. The second was the shale revolution, which was totally unexpected, which made America an energy independent nation. The third thing was Silicon Valley innovation, which eventually led to the bubble. Now, what's interesting is I don't think we're in an American exceptional market anymore. I think what we're seeing is American exuberance, where hype has run ahead of reality. And we can sort of look into that because instead of political and policy leadership, what we have now is a country that's running a deficit of 7% without any sort of recession or wartime, which is not the best policy prescription at this point in the cycle. The shale companies have gone from prioritizing, maximum output to maximizing profits now. Silicon Valley seems to be now, especially post 2021, with where we are today, still struggling in the larger startup landscape and potentially ceding its lead in certain other technologies. So I don't think, America is as exceptional. And I think specifically, if we are in an AI-powered bull market, how is it that since October 2022 or November 30th, 2022, when ChatGPT was launched, how come the German DAX is outperforming the S&P 500? Germany, which has a war in its continent, it's grappling with an energy crisis, political instability, China a competitive threat. How is that possible that German equities have outperformed U.S. equities? If AI is an American story, and you've also had the Chips Act, you've had the IRA, you've got a massive capital capex, and if we're also in an AI-powered bull market, how is it so that a barbarous relic, an ancient store of value like gold, is outperforming them both, up 65% compared to S&P 500, it's up 50, close to 50%. So there's something not right, something not exceptional about what's happening. Either we're too bearish on the prospects of Europe, or we're perhaps overestimating America's strength at this point in the cycle.
Yeah, I mean, in terms of Germany, European stocks, even UK stocks that they've done fairly well recently, is that really just a function of global fund managers looking at their exposure to the US and saying, whoa, 60, 70%, this is maybe beginning to push it. Look at the relative valuations. I'll just shift a little bit out. And given the underweighting of non-US markets, it doesn't take that much to start pushing them up a bit.
I think that's certainly part of it. I just think that it's important to ask a question, which is what is happening that shouldn't be, what is not happening that should be, and if we are truly, in an AI-powered bull market, then this should not be happening. Where the S&P 500 is underperforming. If we are taking a technological leap forward, then gold should not be outperforming S&P 500. Something else is going on, and we may not have all the answers, but one way I think about this, Merryn, is again, if I go back in time, each decade there's a powerful event that occurs, which turns into the zeitgeist and eventually into a mania. So back in the 70s, it was the breakdown of Bretton Woods in 1971, which led to the gold bull market. But in 1980, that stopped working. In the 1980s, it was Japan's taking over the world. But 1980, so you want to belong Japanese equity, Japanese real estate. But 1989, that stopped working. In the 1990s, the zeitgeist was the internet. It only really kicked in 1995, but you want to be long NASDAQ. March 2000, that stopped working. In the 2000s, the zeitgeist was China's interest into the World Trade Organization in 2001. So you want to be long China, EM, commodities. That stopped working in 2010, 2008, 2011, based on whatever asset you pick. The zeitgeist of the last decade was best articulated by Mark Andreessen in 2011 in a Wall Street Journal article titled Software is Eating the World. That zeitgeist, in my opinion, ended in 2021.
What do you think the one for the next decade is then? Where are we going next?
Yes, so there are a few interesting points here, right? So first, because these are 10-year trends, a lot of careers, reputations, businesses are built on that success. It takes a while to dethrone dominant beliefs and behaviors that serve them. So even up until 2014, 2015, we still thought emerging markets are going to come back. We still thought gold and commodities are going to continue to do well. It didn't really happen.
Yeah.
And up until mid 2015, people still thought, America is not the place to be. Back in 2015, Bill Gurley said Silicon Valley is in a bubble. So it's very difficult to discern, when that shift is happening. There's certain candidates, that we can look at. I think there are a handful. We've been talking about a zeitgeist portfolio with our clients. The first could certainly be AI, in which case you want to be long NVIDIA. I think it's too close to the prior zeitgeist for it to be the one. The second could be health and obesity, so in which case you will belong Eli Lilly and Novo. The third candidate could be defense in a multipolar world, so in which case you will belong Palantir and some certain European defense names. And I think the fourth, which is where I lean most, is it could be the energy transition, the race to zero emissions in the global energy transition. So this idea of electrification in trying to serve the climate goals. And I think that's important because just like last decade, it was America's decade. If climate or the sort of energy transition becomes the dominant theme, then the country most important for this decade is actually China, because China is the renewable superpower of the world. And so just like 10, 12, 14 years ago, it wasn't obvious that America was the place to be, it's not obvious right now that China is the place to be. Who would want to invest in a country with a shrinking working age population, a leader for life, a slow motion property crash, massive leverage, potential war with Taiwan, and yet,
Yeah.
Chinese tech stocks outperformed the U.S. market last year, and they're up pretty strongly this year. So again, something else is going on that we may need to pay attention to.
It's interesting, though, isn't it, that you pull that out when, if you flick through the papers, look at what we write, look at what we talk about, it actually seems that what we're seeing in most of the world, the UK aside, we haven't got there yet, but we probably will, what you're mostly seeing is a pullback from the idea of trying to pursue net zero, a pullback from the idea of moving away from fossil fuels too quickly, because it clearly isn't working at the speed that a lot of people would like it to. So we're seeing more of a pullback than a push forward in that area.
And that's how, surprisingly, how markets work, right? Is it's just very counterintuitive. And I think it's more about just understanding the capex required to upgrade the US electrical grid. It's, what's required to sort of create the electricity and the power needed to support even the AI boom now, right? And I think all of that feeds into energy transition and in some ways the race to zero emissions, because you're going to have to find sources that are alternative to conventional ones to sustain this.
To us, that seems to suggest that there'll be a nuclear boom rather than anything else.
I mean, that's certainly part of it. I think natural gas has a big role to play in the interim. But the reason I think Germany is also outperforming is because if we are in this sort of climate era, Merryn, then the solution to climate is not technological, it's industrial. So this is also a time where industrial companies do better. It's not venture capital, it's project finance. It's, working with other governments. And in most cases, China is way ahead of any other nation when it comes to the key technologies needed for that push, which I see bringing Europe and China closer, even if the US sort of heats up political pressure on both.
Sorry, explain that further. Why does that bring China and Germany closer together?
I think ultimately what you're going to have to see is desire for more investment from China. And so, America could benefit from that. Europe could benefit from that. So you're going to play economic diplomacy. You're going to see a shift towards EVs globally. You can try if you want to stop that, delay that, but we're already seeing it happen across emerging markets. And the developed world is going to be slower because of political preferences, but ultimately you're more likely to see Chinese companies taking over European auto plants than European companies competing or out-competing Chinese ones. And so it makes sense. And I think there's a very interesting comment even by Ursula recently where she talked about how we need to figure out ways to compete and collaborate with China and get closer. We're not necessarily at the cusp of this delinking globally from trade linkages and sharing technologies that sort of will help propel us to the next sort of iteration of global growth.
Okay. I want to come back to European stocks in a minute, but before I forget, I want to go back to gold, where you said something's going on there. Well, what is it that you think is going on with the gold price?
I think it really began for us with the sanctions on Russia. So there were three basic strikes to Pax Americana. Strike one was post 9/11, where America suddenly went against the international order and invaded a country, a sovereign nation. And you realize, wait a minute, sovereignty doesn't mean anything. So that was the beginning of the rise of the strongman. So you suddenly lost faith in America as the global protector or as the benign hegemon. The second strike was in the GFC, when you realize, wait, we can't trust America as the global economic manager because subprime was an American creation. And that's when China sort of decided that we got to separate ourselves from US banks as much as possible in the US financial system. The third strike was the sanctions on Russia, where you confiscate state assets, where you suddenly realize, wait, we can't even trust the national property rights anymore. I mean, that was sacrosanct. And so I think since then, you've seen, that's strike three of Pax Americana, which basically means we're entering a different world order going forward, right? And the risk is that America is acting like a hegemon in a multipolar world that creates instability, that creates uncertainty. However, since then, what we're noticing is that gold buying among central banks has really picked up. And it's also to a point where, it's not responding to the rise in real interest rates. It's not responding to the rise in the dollar. And I think that is an extremely powerful trend. And I think that continues.
Okay. We did a podcast on gold a little while ago, so we can leave listeners to go and re-listen to that, because I think a lot of things that you said chime very, very neatly with what we discussed previously. You also mentioned Bitcoin, which you say has peaked. Do you see Bitcoin as central banks aside fulfilling the same role for investors as gold, or do you see it as something completely separate?
I think the big question with Bitcoin specifically is that does it trade like NASDAQ or does it trade
Mm-hmm.
inverse to the dollar? And
Mm-hmm.
I think historically it's traded like NASDAQ. So given our
Yeah.
scenario where we think risk assets could be down materially over the next 2.5 years, it's difficult for me to see Bitcoin decouple from that. Even
Right.
initial signals from greater political tension, whether it's tariff news, you see Bitcoin sort of selling off on that, across the sort of crypto total market cap sells off on that. So it's difficult to see that as a hedge or trading inversely to broader risk sentiment.
Yeah, no, it's interesting because we do keep being told, don't we, that Bitcoin is a diversifier and a long-term store of value and all these things, but we have no evidence of that yet. And when we look at gold and when we look at Bitcoin, when we discuss Bitcoin and when people come on and discuss Bitcoin with us, its value today is based on its perceived role in the future. Whereas when we talk about gold, its value is based on the role it has already played in the past. And we can expect it continue to play that role. So in that sense, they're very, very different assets, one based on history and one based on expectations.
I still think it's all a function of the cycle, right? At some point,
Mm.
Bitcoin post COVID has crossed the Rubicon where you're seeing now even greater institutional adoption. So I think it's an asset that continues to be relevant and will continue to make institutional inroads. The question is,
Uh-huh.
when do you invest? At what point in the cycle are we in? And what we typically see is when the cycle turns, you have MicroStrategy giving you some indication where MicroStrategy peaks and Bitcoin follows, months later. So as of right now, MicroStrategy peaked in November. As of now, Bitcoin peaked in January. I'm open-minded to another move to like 120, 130 maybe in the next few months.
Mm-hmm.
But I do suspect that will be a top that stays in place for quite some time.
Okay. So you're advising institutional clients in the main, I think. But let's imagine that you're talking to a retail investor, possibly a listener to this podcast. How would you recommend that they allocated their assets at the moment?
Time frame matters, but if you were to say this is a multi-year sort of allocation,
We're going for a decade. Let's go for a decade.
yeah, then I would say you want to be long China and Chinese
Mm-hmm.
equities. I think we are underestimating the innovation coming out of China and Chinese brands, and I think so. You want to be long China, I would say, is the top one, and there's specific companies you can look at there. I would say you would want to maintain exposure to gold and silver as well as part of your allocation. And you would want to get exposure to commodity names that would sort of benefit from the electrification and decarbonization story, right? So that is copper, that is aluminum, that would do well. I think there is going to be a natural gas or LNG boom that will sort of perhaps lift natural gas prices as well. So there's something to be done over there too. But the best decision an investor can make typically is avoiding the zeitgeist of the previous decade. So, in 2010s, if you just avoided China EM commodities, you would have done fantastically well. If in the 90s you avoided Japan, you would have done well. In 2000, if you avoided NASDAQ, you would have done well. So that just tells you that we're in an era now where the US will begin to underperform the rest of the
So
world.
if you were to, if you didn't do anything else, if you're at the very least to rebalance yourself away from the US, away from tech, away from AI, you might be doing yourself a favor.
I think so.
Okay, interesting. And what about access to the extraordinary dynamic entrepreneurialism in the Middle East? So, for example, in the UAE, if you go to Dubai, Abu Dhabi, and you see these extraordinary economies being built, is there any way to get exposure to that? And would you advise that?
It's not an area of focus for me. I mean, a lot of the innovation that you're talking about is happening mostly in private markets and through venture capital funds, right? So I think that would be the way to get exposure. How we haven't had a long enough cycle to really determine how those funds have truly performed. You've got this dynamic where the economy is not so much reflected in the stock market in terms of the market cap versus economic weights. And so, the stock market is not necessarily the best exposure either. So it's really a function of what you want to do and what your view on oil is. It's because fundamentally speaking, if you're looking at the public markets, it does provide a beta to oil to a certain degree.
Jawad, I'm going to ask you a question. I used to ask everybody, but I've slightly stopped asking now, and I already think I know where you're going to go with this, but I'm going to ask you anyway. Over this 10-year period, if I offered you a choice of Bitcoin or gold, which one would you take? You're only allowed one, by the way.
I would take gold.
Yeah, I thought you might. Given what we've just talked about. And if during that 10 years you were to recommend a book to people to read that might help them get through this next decade in markets or in life, what would you recommend, do you think?
I would recommend The Screw Tape Letters by C.S. Lewis. I think it's the most important book of our time. It's basically a senior demon writing letters to a junior demon about how to corrupt humans, which he calls the patient, and keep him away from the enemy, which is God. So it's a fascinating exchange of letters, which is basically the inside game of how we are foiling ourselves. And so in a decade which could be, more problematic politically, economically, socially, I feel like we need to have a better understanding of how we are being led astray. And I can't think of a better book than C.S. Lewis. And what's actually better is to listen to it, because John Cleese does the audio version, which is fantastic in his voice.
Oh, sounds great. Okay, so we are being led astray. Who do you think is leading us astray?
The enemy. I have seen the enemy, and it is us.
Thank you. Thank you very much for joining us today.
Pleasure as always.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. The show is produced by Summer Sadi and Moses Andam. Sound design by Blake Maples, and special thanks, of course, to Jawad Mian. Thank you.